Hey everyone, let's jump right into this explainer on Cogeco's Q3 2026 earnings. If you just skim the headlines, you'd think you know the whole story, right? Well, as always, the real narrative is hiding in the margins, the strategic shifts, those long-term plays. We're going to break the whole shebang down today.
All right, so we're looking directly at the official Q3 shareholders report ending May 31, 2026. Now, I know it's super easy to get totally lost in the endless tables and accounting jargon of these things, but if we actually read between the lines, this report outlines a massive corporate pivot. Cogeco is right in the middle of battling industry-wide headwinds while frantically trying to reinvent its core offerings. So here's our roadmap for this explainer. First, we'll look at the billion-dollar write-down, then the revenue and profit squeeze, Canadian telecom's silver lining, the American telecom battlefield, and finally, cash flow and capital.
Okay, let's kick things off with Section 1, the billion-dollar write-down.
To really grasp where Cogeco is at right now, we've got to start with the shocker that jumps right off the income statement. Yes, you're reading that number right, a staggering $1.75 billion net loss for the quarter. Now, for a company of Cogeco's size, a loss like that immediately sets off alarm bells. If you stopped reading here, you'd literally assume the business was in free fall.
But hold on, before we think the company is going bankrupt tomorrow, we have to understand what this actually is. That massive deficit is largely due to a $2.2 billion non-cash impairment charge. Think of this as an accounting revision. It absolutely does not mean $2.2 billion in cash just vanished from their bank accounts. Basically, management looked at their American telecom and radio assets, realized the projected earnings were much lower than they previously thought, mostly thanks to fierce competition, and just adjusted their book value downward.
Moving right along to Section 2, revenue and profit squeeze.
All right, so with that paper loss out of the way, let's step back. How did the day-to-day business actually perform? Well, the top-line reality is that consolidated revenue decreased by 4.5%, down to $724 million. You know the story here. Cogeco is facing those massive industry-wide headwinds. Consumer habits are fundamentally changing. People are cutting the cord on traditional TV and home phones faster than ever, and competitors are aggressively fighting for every single internet subscriber.
But here's where it gets really interesting. Cogeco didn't just sit back and take the hit. Their response was pretty aggressive. They executed a 6% cut in operating expenses. By seriously tightening their belts, part of this ongoing 3-year transformation program they actually cushioned the blow. This cost-cutting limited the drop in adjusted EBITDA, which is a key measure of operating profit, to just 2.9%. So they're essentially shrinking their expenses faster than the revenues are falling just to protect those margins.
Which brings us to Section 3, Canadian telecom's silver lining.
To understand exactly where this revenue pressure is coming from, we really have to look at a tale of two entirely different markets. And this brilliantly illustrates the core tension in the business right now. On one hand, you've got the Canadian operations, which actually managed to eke out a slight revenue growth of 0.5%. But on the flip side, the US market took a huge hit, dropping over 10%. Right now, the Canadian market is absolutely the stabilizing anchor for the whole corporation.
Let's zoom in on those Canadian numbers for a second. While traditional video and wireline phone units are tanking, losing over 9,000 and 6,000 subscribers respectively, thanks again to cord cutting, the Canadian segment overall remains surprisingly buoyant. Why? Because they successfully added nearly 4,800 internet subscribers this quarter. The internet business is literally strong enough to carry the dead weight of those declining legacy services. So, what's their game plan to keep this Canadian momentum going? It's a two-step strategy. Step 1, a relentless push to expand their physical fiber network footprint to reach more homes. And Step 2, the full-scale launch of their new wireless offering, Cogeco Mobile, which just expanded across most of their operating footprint in Quebec and Ontario. They're actively pivoting to become a comprehensive mobile and internet provider.
Now, let's cross the border. Section 4, the American telecom battlefield.
If Canada is the anchor, you guys, the US is the storm. The US segment is seriously struggling. Like we saw, revenue is down 10.1%. They're facing incredibly intense competition down there, especially with aggressive pricing for entry-level internet. Add to that, American consumers are rapidly shifting toward internet-only households. They're abandoning those highly profitable bundles of the past, which is causing a continuous steep decline in standalone video subscribers.
But to be fair, they aren't just sitting still and taking the punches. Management actually points out in the report that they are actively fighting back. They're rolling out new sales and marketing strategies and making some really targeted investments in their network infrastructure.
And they specifically noted that these strategies are starting to show some positive results, particularly in Ohio, where they actually managed to add thousands of internet subscribers. And maybe their most prominent defensive maneuver in the U.S. was the launch of Waylo. Unveiled in February 2026, Waylo is a brand new digital challenger brand. It initially rolled out in Columbus and then expanded across their entire Ohio footprint. It's designed to operate right alongside their existing BreezeLine brand to capture new, probably more price-sensitive and digitally focused segments. It's a fascinating dual-brand strategy to try and stop the bleeding in the U.S. market.
Finally, let's talk money. Section 5, cash flow and capital.
This is where the rubber really meets the road. It's where all these complex operations, massive write-downs, and strategic pivots actually translate into money in the bank. And the crucial point here is a major narrative twist. Despite that multi-billion-dollar paper loss we talked about at the start and the shrinking top-line revenues, free cash flow actually increased by an impressive 15.7%. It jumped from $147.5 million to over $170 million for the quarter.
So you're probably wondering, how on earth does a company generate more free cash while losing top-line revenue? Simple. By ruthlessly executing that 3-year transformation program. They aggressively lowered capital expenditures, specifically spending way less on customer premise equipment in the US, and they realized deep operational efficiencies across the entire corporation. Essentially, they are squeezing out every drop of cash from every single dollar of revenue that still comes in the door.
And, even with all this lower spending, they still managed to maintain a really healthy 17.3% capital intensity ratio. To put that into perspective, it means they're still taking over 17 cents of every dollar earned and plowing it right back into their network. That ensures their infrastructure stays competitive for the future even while they're slashing costs everywhere else.
So as we wrap up this explainer, we're left with the ultimate multi-billion-dollar question, right? Will this massive pivot to new digital brands like Waylo and Cogeco Mobile, paired with this incredibly strict cost efficiency, be enough to outrun the structural decline of legacy telecom? I mean, the cash flow tells us they're definitely surviving the storm today. But the real test is whether these new seeds of growth can truly replace the fading giants of their past.